Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key market drivers and themes driving those markets at the moment. We look at both fundamental reasons for why markets are moving and also hopefully dive into some technicals as well, technical analysis and some price levels, support and resistance that we watch and hopefully do hold some validity, if you like. This week, while I just let you have a look at the disclaimer, I'll just run through what we'll be going through for the next 40 minutes or so. We'll look at the key drivers actually currently as markets shape up for this week on sort of Monday morning, wherever you are, Monday afternoon potentially as well. The Fed and China as well are in focus. Particularly today and this morning over the weekend reports, obviously around this loosening of the zero COVID policy by China. Also got obviously the Fed's decision last week. That really sort of in the background kind of at the moment, but some Fed speakers, a lot of Fed speakers this week to watch out for, as well as the US CPI data. We'll do a look, as we normally do, at US stock indices, technicals around those, and then we'll also look briefly at this old and new economy divergence that has been playing out, and potentially if that is to slow maybe. All dependent, of course, on the Fed. We'll then review, obviously, those main events from last week. So that is obviously the FOMC meeting, and also then briefly look at non-farm payrolls, of course, on Friday, and then the Bank of England meeting and the RBA meeting as well last week. Before then, previewing the US CPI data and US midterm elections, which we get on Tuesday. Maybe not a major market driver, but worth having a think about those and the potential impact of a Republican win, or obviously split voting, if you like. Okay, firstly, we'll look at markets in general. If you just bear with me 1 second. Sorry about this, just bear with me. Sorry, a little malfunction here. Right, here we are. Apologies about that. Okay, so markets, how they're shaping up this week. So European stocks are pretty mixed on Monday morning, actually. Investors, as I said, mulling over these reports of China's zero COVID policy, that loosening potentially. Kind of had conflicting reports, really, from what I've been hearing and reading. We had those weekend reports from China's health ministry that China will maintain its present zero COVID regulations, but also then improve the pandemic control measures. And that sort of hinted at these protracted lockdowns potentially being avoided going forward. That said, I heard actually on the squawk that we have here just around new lockdowns being initiated in certain parts of China as well. So sort of conflicting reports, we think, at the moment. It's always difficult to read, for sure, China health policy and interpret that. And certainly we've had some other Chinese officials pushing back against speculation around the country dropping this zero COVID policy. So sort of conflicting reports, but sort of essentially mixed performance in European stocks at the moment. We also had Chinese data actually this morning, a drop in Chinese exports, and that's kind of another signal that there is slowing global demand, and that's certainly been a major drag on Chinese growth. And then overriding all of this, we think as well, we have to bear in mind, of course, this risk equation. So the search for a higher Fed peak rate, if you like, and then certainly uncertainty still around the medium-term economic outlook and around the energy crisis as well. Any pushback, of course, on that is helping stocks and hurting the dollar. And certainly with this warmer European weather we've been seeing here, this outlook potentially for that disastrous outlook in a way that we had, say, a couple of months ago around Europe, and potentially a really bleak winter. Obviously, sentiments changed slightly on that perspective with this warmer weather, gas prices then coming lower, which has obviously been a major driver, a major concern for risk sentiment, and especially European sentiment as well. Just going back last week, actually, we've got the dollar here, but just looking at last week and equities really. If I pull up the S&P chart, you can see here, I'll just take off the Keltner channels just to make it easier to read. Last week, the equity rally, well, it kind of lost steam slightly, although we recouped some losses on Friday. The Fed kind of played good cop and bad cop, if you like. Powell, and we'll look at this in more detail shortly, he obviously guided more hawkishly, and that sent equities lower. But then we've had Fed speakers out on the wires, seemingly sort of striking a slightly more dovish tone, and thereby lifting equities. And then, of course, we've had this China story as well, helping risk sentiment globally. I just wanted to highlight, again, this sort of divergence between growth and growth stocks, that is, and old economy stocks, value stocks, if you like. Growth underperformed again last week by around 4 percentage points. That's globally. That actually marked the worst 5-day session for growth this year. And equities generally, although they were higher, and the S&P obviously closed up 1.4% on Friday. But it's the NASDAQ, again, those tech growth stocks, which have again underperformed, even though that was, I think, over around 1.3% higher on Friday. The drop for the week was 4.6% in the NASDAQ, so the biggest decline actually since late January. And there's certainly concerns over that higher endpoint for interest rates, weighing on tech stocks. That obviously the NASDAQ is tech heavy, tech laden, and they're more sensitive to elevated borrowing costs. The S&P, in contrast, down slightly less, down 3.4%. That was still the biggest weekly decline since late September. But again, it's this contrast between old economy and new economy. So the old economy stocks, comprising those that are value-based, really, they're typically based or typically perform better due to their more stable earnings. And certainly growth stocks, value stocks, they're really sort of trading. Well, if we think generally then about, this idea, just sort of on a more basic front, really, this difference between value stocks and growth stocks. Value stocks, they're usually larger, more established companies, so they're less risky, sort of less volatile in the main compared to growth stocks. The idea is that they're currently trading below what they are really worth, and will therefore provide a superior return. And that is obviously in contrast to growth stocks. Those are companies considered to have obviously big potential to outperform the market, the overall market over time because of their future potential. So sort of just coming back to basics really about that difference between value and growth stocks. And then value still, as I say, usually larger, more established companies, and they still, it must be said, offer capital growth. and they pay dividends, which is a sort of probably a key difference with growth stocks generally. And that is why if you see long-term charts, generally value stocks outperform growth stocks over the very long term, and that is probably down essentially to these payment of dividends. Whereas let's caveat that obviously in the last 10 years or so, then growth stocks have been outperforming value stocks. And that's been this key theme really over the last few weeks with these rising interest rates. High growth tech names, certainly they're impacted and prone to fears of rising interest rates, since many of them are value based, or their value, sorry, is based on their projected profits far into the future. So key, we've always said, been going on really about the Fed and their tightening cycle, but understanding that obviously then gives us a picture as to the drivers for the NASDAQ, for the Dow potentially, and going forward then, if we're getting this slower pace of rate hikes from the Fed, then potentially the NASDAQ may start to perform slightly better. The Dow then stacked full of old economy stocks, value stocks really, then that potentially, that performance comes off slightly. I think then you can see it in the S&P chart, and we'll look at the Dow chart straight away afterwards, and you can see the difference really. But for technical basis, we've obviously had this sort of descending channel from the August highs. We got below 3,500. In fact, if we just go to the weekly, just trying to ignore that sort of short-term fib levels, you can see we've highlighted over a period of time then 3,500 key level. That's halfway point of the pandemic low, and the all-time high 3,505, actually the 50% level. We tapped that mark, and then you can see bounced very strongly actually on that. That was a strong turnaround actually on the CPI data, and then we pushed up obviously into then SMAs really, simple moving averages. The 100-day moving average, that light grey line, 3897 now, that area is capped the upside so far, and we've dropped below the 50-day moving average. That's that light blue line at 3804, and then we've sort of dropped down to the 21-day moving average here, the very light grey line, 3731. So we're trading just above that now in the S&P. You can see the futures actually picking up. That's the futures, and we're just sort of pushing up now towards the 50-day moving average around 3,800 there. Futures looking good actually at the moment, up over 0.8% on the day, starting in 15. Actually, the clocks have gone back now in the US, so starting in just over an hour, a couple of hours time now, US markets. So really sort of upside capped by, if we just go to the cash market, upside capped by the 100-day moving average. We see still just below 3,900. Downside, we've still got the mid-June level, 3636 really is a key level for us, because we traded below it briefly for a few days, but then bounced quite nicely above it. So 3636 still a key level for us. Strong support. If we look at the Dow now quickly, you can see, sorry, that's the NASDAQ. Let's look at this as well. Descending bear channel, struggling to push towards that 100-day moving average. You can see didn't get there, just about got to the 50-day moving average, but not at the time. And obviously now that's turning low as we've rolled over really in the NASDAQ, even though obviously Friday helped us off the lows of last week. Again, we've got the mid-June low around just above 11,000. We think still sort of key level. The 21-day moving average then above 11,100, 11,000, all the ones actually. So another line of resistance potentially, initially anyway. And then as we say, we've got that 50-day moving average, 11,551, potentially capping any upside again. Otherwise, we drop back really. We've still got the descending bear channel on there, but we kind of have broken out of it. So really, we should take that off now. And you just see really just the longer term sort of bear trend. We get back into that, and then we've obviously got the mid-October low at 10,440, just below, sorry, 10,500 really, acting as near-term support. Just looking at the Dow, we think, just to show you this highlight really this divergence and this strong, really nice strong rally really from these lows at 28,715 really. Strong bounce off that mid-October US CPI data, strong bounce up to, where have we gone now? Up to sort of 33,000 really. We got to 33,071, but is this 200-day moving average now, this thick black line really, that's capped upside before, you can see earlier in the year, in springtime, and then obviously in summertime, that capped the August rally. So really key level for us, that's at 32,567, the 200-day moving average, that is, on the Dow. If we can break above there, break above 33,000, then potentially we get up to 34,000 and the August highs. Support then, last week's low, 31,727, and then we've got we've got the 100-day moving average at 31,426 in the Dow. Okay, if we just look now at firstly the non-farm payrolls, just bear with me 1 second. Firstly, yeah, the non-farm payroll figures. And we've got a summary here, of course. Right, non-farm payroll from Friday. We'll then look at obviously the Fed meeting, the Bank of England meeting, the RBA, before getting to the US CPI. Again, can't stress enough how important it is just to get a handle on obviously the central banks, what they're doing, and certainly the Fed, obviously the most important central bank out there. Before that, non-farm payroll, obviously a key data point, the seventh straight beat actually on the headline figure, gains of 261,000 against expectations of around 200,000. So slowing from last month's actual 315,000, that was revised higher from 263,000. Job gains really broad-based. Strong gains in healthcare, professional business services and manufacturing. Wage growth, that held up quite strongly, coming in at 0.4% month on month in October from 0.3% previously, although it was a touch softer on a year-on-year basis, 4.7%. That matched forecast, but was lower from the previous 5% year-on-year figure. Interesting that kind of the market focused on the unemployment rate, actually the jobless rate, that ticked up above forecasts to 3.7% from 3.6% previously, 3.5% before that. Excuse me. Really on a rather weak household survey, although it was met with a 0.1% decline in the participation rate to 62.2%. But as I say, markets kind of focus on that jobless rate and potentially, obviously, headline grabbing sort of layoffs going on actually at the moment. Potentially, obviously, Twitter grabbing the headlines, Apple as well, hearing layoffs potentially happening there, especially then in sort of the tech sectors. And it'd be interesting to see how that plays out with obviously non-farm payroll figures, the headline figure, and then obviously affecting the Fed tightening path potentially going forward if we do get just more job creation, but obviously at a slower pace. The average, I think at the moment, 3-month average for the headline payroll figures, 289,000, but that's come down from the year average above 400,000. So something to watch out for, obviously, as always, the monthly figures, non-farm payroll figures, the headline figure, and then also that unemployment rate, potentially higher rates, obviously affecting potentially unemployment going forward. Just bear with me 1 second. We've got a question actually. Just bear with me. Just asking about last week, towards the end of the week, Thursday, Friday, didn't expect Brent oil's bullish move, being so off with bearish movement. Can you give me a take on the 4-hourly structure, I think? Okay, just we'll get to that in 1 second, if you don't mind. We'll just look at the Fed, and then we'll come back to oil. Actually, we'll look at US CPI, look at gold, actually, technical take on gold, and then we'll look at oil technicals as well. Hopefully that's good for you. Okay, just looking at so just non-farm payrolls, just that pace of job creation to bear in mind, although we've got this chart up here, which is the unemployment rate. As I say, markets focused on that uptick to 3.7%. But if you look at this chart, you can see unemployment rate really right at those lows still, long-term lows, 50-year lows was 3.5%. We're still very close to those, actually. All in. So just again, markets focusing on sort of near-term figures, but then we like to bear in mind sort of longer-term outlook as well. And you can see for sure that the unemployment rate still near those multi-decade lows. Okay, just concerning then the Fed. Yes, so they raised rates, of course, as expected, by 75 basis points, the 4th straight 75 basis point hike, taking the target range to 3.75% to 4%. But it really was a meeting of two halves. And I think it's worth highlighting this simply because it's sort of, you can extrapolate this, the market reaction that we saw during the Fed meeting when the statement was published, and then obviously the press conference. Those were the two halves. Those were the two market reactions we got, and you can kind of extrapolate that to potentially what happens now going forward. I've got this chart here that you can see, but firstly, let's sort of run over those two halves, if you like. Firstly, the statement that hinted that more hikes would most likely be at a slower pace, that pace being 50 basis points potentially. It said, the Fed said, they'll consider three things in the statement when determining the pace of future rate increases. So if you remember, they said about the cumulative tightening of monetary policy, that was one thing. They also talked about the lags with which monetary policy affects economic activity and inflation. And then they also talked about economic and financial developments, which to us obviously says they're looking at incoming data. So that was in the statement. Markets basically rationalized that with rates in restrictive territory, then the Fed can downshift to this slower pace of normalization, really to assess the impact of the 375 basis points worth of tightening now, which we've seen obviously from the Fed since March. And you had really a wave of optimism, flushing over markets. You can see that the S&P actually got, I think, was up over 1% straight away after the statement. The dollar then came off with US bond yields coming off as well, selling off and going lower. But then sadly, we had the second half of the meeting really enter Jerome Powell, the Fed chair. He basically confirmed that future hikes could be of a smaller magnitude, but maybe not straight away. And they may come at the December meeting or the one after that. But he also said that incoming data since the meeting suggests that the terminal rate, so this peak rate that we've been talking about for a long time, that will be higher than the 4.6%, which was penciled in the September dots. It was actually 4.5 to 4.75%, but the average of those dots, average of what all the FOMC members thought was around 4.6%. So Jerome Powell said that potentially rates will go higher than that terminal rate of 4.6%. And so a pause in rates, he said, was very premature to think about. You kind of think then that his task, really, he probably set out this task to announce a slowdown without suggesting that it is at the beginning of the end, if you like, and this hope for pivot. And pre-press conference again, before the press conference, market reaction, it kind of showed us what would have triggered a furious risk-on rally, of course. And then otherwise then that would have undone a lot of the previous delivered tightening of conditions. And in a way you could say, and I know a lot of people, some people on Twitter certainly, they were quite upset with what Powell did, obviously in the press conference, but really it was a job well done for him. If you think that or if you look then at the market reaction afterwards, after he said that it was premature to think of tightening and the pivot was probably too early, even though the Fed will continue hiking rates, but at a slower pace. That peak rate will be higher. And markets, certainly they reacted. Wall Street slipped. The Dow closed 1.5% lower, just over, I think, and the Nasdaq was over 3% lower. And the dollar, certainly it picked up and surged, actually, the euro dollar dropping to around 98.20, I think, the low immediately after the Fed. Going forward, I think a couple of points to note then, and really key takeaways. So the Fed, they felt that the speed of the hike or the speed of hikes in general is becoming less important, leaving really the market to infer that the Fed just keeps hiking at more meetings if incoming data supports that. Secondly, we must remember that the Fed has cranked up the pace of quantitative tightening in the background. That's QT. So that's where it's reducing the size of its balance sheet. If you remember, nearly $9 trillion, the size of that earlier this year. So it's letting bonds that it holds on its balance sheet roll off. So it's not roll off when they mature. But that pace of quantitative tightening, QT, that provides really its own tightening pressure on markets and arguably actually equates to a few hundred basis points of rate tightening over the course of a year. So we have to remember that as well. The Fed will be taking that into account as well, we think. And then thirdly, really the Fed, they've raised rates certainly, as we've said, 3.75% this year. That's the fastest pace of policy tightening since the late 70s, early 80s, with Paul Volcker at the helm. And the danger, we still want to highlight really, the danger is that the harder and faster a central bank moves into restricted territory, certainly to get a grip on inflation, which is their aim, and then to crimp demand. Certainly there is less control over the outcome, and then potentially the greater chance of a slowdown, which is kind of what they're engineering, but the potential slowdown, chances of a broader recession. Interestingly, since the meeting, actually, we've highlighted and we've sort of said there have been other Fed figures that have begun to ease that rhetoric slightly. Markets kind of desperate for some sort of signal about this pivot. And we've had a few speakers actually acknowledging that the policy, well, it acts with a lag, as we've said, which is kind of significant. Change to messaging potentially, even though for sure the Fed should surely know and be aware of this lag in putting up rates to then affecting the economy as a whole. But as I say, we've had a couple of speakers, we had a couple of speakers on Friday, certainly saying policy is kind of entering a new phase. and that could require actually smaller hikes, as well then as the slowing of the pace of increases. Again, we have to say markets latching onto that potentially, but I think it was Barkin, Thomas Barkin at the Richmond Fed, acknowledging as well that rates may need to rise above 5%. So in a sense, really, you kind of think the Fed are giving themselves sort of greater optionality as really to respond to trouble, respond to the data as it sees fit. Although at the moment, certainly rates are going above that 5% level. Just looking at some graphics, then you can see on this one we like to show really that U-turn in markets from pivot to hawk. The light blue line is yields. They dropped obviously quite sharply, very sharply. That's a 2-year yield, your 2-year treasury yield. This is now, which tracks Fed funds. Probably is the most highly correlated, more than the 10-year treasury rate. So that dropped, as you can see, quite sharply, but then picked up on the change from the statement to Powell's press conference. And then the light blue line, you can see that picked up over 1%, just about. The S&P 500 there in the light blue picked up with this potential pivot in the statement, but then really tanked on, again, the Chair Powell's press conference. And then this graphic, you can see the Fed funds rate, just really that slow but protracted uptrend in the Fed funds rate. This is actually from May 2023. So the prediction of where that rate will be at that time in May 2023. And you can see then picking up just beyond 5% or so. Okay, let's now look at the other rate meetings actually from last week as well. We had the Bank of England actually, just touch upon them first of all. So they hiked by 75 basis points, but they certainly seem to tweak the policy message. We kind of, if you read our daily commentaries, we kind of hinted that we thought they may go 50 basis points only, but they went 75, which is what the market was expecting. But as I say, they really tweaked their language, tweaked it to being a lot more dovish. And really that triggered quite a sharp reaction in sterling, down 2% on the day, I think it was, but over probably around 1.5% after the Bank of England meeting, which is kind of quite similar to a reaction probably if they'd only hiked 50 basis points. But the bank, they certainly pushed back firmly against what markets were previously pricing in. That's tightening of a peak rate of around 5%. And Governor Bailey, certainly he emphasized in the press conference that market pricing had gone too far, actually, adding in the forecast that following actually market implied rate path could cause a 3% point economic contraction over several quarters and inflation at 0 in 2025. So really the bottom line is that the Bank of England is kind of shutting the door, we think, to another 75 basis point hike. We should expect smaller hikes going forward, but still on balance, certainly inflation is still far too high and interest rates will rise further. But again, it's this slowing pace of rate hikes is very likely. The negative reaction in the pound, certainly that was due then to this dovish repricing, if you like, in rate expectations, but then also the dynamics around the rather the grim domestic outlook, 2 years potentially of recession or really subdued economic activity. And that was flagged quite clearly by Governor Bailey, by the Bank of England. Just moving forward then, well, actually looking at the chart, then you can see then the white line then implies rates where they were going above 6%. If you remember, it's called, the crisis peak implied rate, really after the mini budget, obviously in late September, and this ramp up in yields that we saw in the UK above 6%. But now you can see the grey line, we're back below the September implied rate, and below 5% for sure. Markets thinking the implied rate, but remembering, of course, that 75 basis point hike last week took us up to 3%. So still some more work to be done, the market thinks, by the Bank of England in trying to get inflation back down to target, nearer to target, we should say 2%, and UK CPI double digits still. So yes, that's the implied rate. And if we just then look at sterling cable for sure, just bear with me while I pull up the chart. Interesting, really, cable. Kind of drivers at the moment. If we look beyond really now the Bank of England, then the drivers are, sterling is closely correlated to global risk sentiment, and certainly the dollar dynamics as well are playing out, even though, of course, there's this grim outlook in the domestic economy, and the potential slowdown that we will see going forward. Obviously, that is known to the markets. The markets expect that. So near term, certainly the fiscal update next week, that will be important. And certainly if we get a tighter fiscal policy, plus then slightly more dovish monetary policy, that is bearish for the currency, bearish for sterling. If we look then at the technicals, the weekly, you can see that we fell to, bear with me actually. So the low, obviously, well, on the weekly, we can see we fell, briefly and sharply out of the bear channel. We like to keep that bear channel there because we're kind of still in it, really. If we go probably to the daily, you can see, just poking out of here. Yeah, obviously that sort of very sharp spike lower in Tokyo hours. Let's not forget, we think that's quite important. Obviously that 103.56 low, real spike low in thin liquidity, obviously sharp bounce back higher, but obviously with that sort of regain credibility, if you like, with the change of leader, change of chancellor in the UK, and then we've obviously pushed up, pushed down again to sort of bottom of that channel, and then up to the top of the channel around 116.83. You can see there, didn't get quite to the 100-day moving average, actually, that grey line, 116.83, and sort of a couple of times, actually a few days, actually top of the channel, couldn't quite go above it, and then we've rolled over. We've still got the pandemic low in there, 114.09, which we dropped below, as well as these SMAs, the simple moving averages, 50-day moving average at 113.30, the 21-day just below that, 113.25. So they'll act as support for this move, potentially above the pandemic low again, 114.38 we are currently, so above the pandemic low at 114.09. But then we have this sort of descending, top of the descending bear channel. Where are we? Probably initial resistance then around 115.34 or so. If we do break out of that, then we have the 100-day moving average above. But for us, still trapped potentially in a long-term downtrend. Moving on then, I think we'll move to the RBA now. Just briefly, actually, they sort of upped their inflation forecasts, but they did point to downgrades in GDP. They remain dovish potentially, and really hiking by only 25 basis points. Actually, they took the rate to 2.85%. But as I say, remaining really a dovish stance. rates sort of bordering on restrictive, really. But it is the CPI forecast they raised, as I said, to 8% from 7.8% this year. That means we could get that CPI printing around 8% mark or so going forward. But they, as I say, they did downgrade their GDP forecasts, only expected 3% this year and then 1.5% next year and in 2024. I think interesting for the RBA to point out, probably why I'm talking about them, is that their rate hike since May, their rate hike cycle, since May, has been the second fastest in history. And the RBA was the first major central bank really to under-deliver on rate hike expectations. That was last month, of course. And then if we think about what's ahead, then the RBA kind of has a history of stopping rate hikes early, so before CPI has peaked in year-on-year terms. And over the last 30 years, I think the RBA started easing early and cutting rates despite headline CPI staying above its 2 to 3% target. So I think we think that's something to bear in mind. Potentially, if the RBA makes any hints of becoming even more dovish at its next meeting, then that potentially, as it's even though CPI is elevated, they have a history of sort of slowing up on rate hikes before it gets back to its target. That is 2 to 3%, that target range. Then potentially a more dovish hint next time, then we see an outsized market reaction in, for example, the ASX 200, and then also the Aussie dollar. Just looking at that, then technically the Aussie against the dollar, we got 6 days, actually 6 down days before this about turn, obviously, that we've seen in commodity currencies, in also the dollar selling off, but this surge in commodity currencies that we've seen recently, last couple of days anyway, obviously on the China reopening story, essentially. Technically, we think, yes, 50-day moving average, again, that could cap upside at 65.20. That sort of tallies with this zone of resistance, if you like, that we saw in early October and then late October around 65.20 or so, the high 65.47. So that potentially acts as a resistance zone. But we're kind of still in this long-term sort of trend for lower prices, really, we think, unless we do break above that resistance zone for the Aussie dollar. Okay, moving on to this week. Finally, let's just look at US CPI first of all. Analysts expect headline to pick up actually by 0.7 month on month in October, accelerating from 0.4% in September. The core measure seen cooling actually a touch to 0.5%, lower than the 0.6% in September, but still elevated versus historical levels. The data, of course, will be framed in the context of how much progress the Fed is making towards lowering inflation. And certainly after last week's meeting, Chair Powell, he noted that inflation remains, of course, well above the Fed's longer run goals, with price pressures evident across goods and services. And although longer-term inflation expectations still appear well anchored, the Fed certainly wants to see inflation coming down decisively. And really, we kind of think it's still prepared to stay the course until that job is done. And certainly Chair Powell, he did highlight that if you remember his quote, actually, the ways to go, I think, is what he's saying. So still, they're still prepared to see growth impacted to get inflation down. Certainly then a lot is dependent on data, dependent on inflation metrics coming down, certainly then aggregate inflation data. So that's obviously Thursday CPI data, but then also the PCA data that we get, and also then wage metrics, certainly within jobs data. That's why they're being highlighted a lot, because all of this aggregate data together then will impact what the Fed does potentially. And it will may give cover, the Fed cover to downshift to this lower increment, this lower raising in hikes. Although, again, if the data doesn't cooperate, then the Fed will potentially prefer larger size hikes. And then obviously then this terminal rate goes above 5% even more. You can see on the chart then, we're still elevated, still expected to remain pretty sticky, 6% there. You can see for core, that blue line, and then the orangey line still sort of above 8%. Potentially we get that dropping back, but we're still very elevated compared to the Fed's target of 2%. I think worth highlighting as well this week, those US midterm elections tomorrow. Opinion polls indicating we get a Republican majority in both the House and the Senate. I think that's still holding, those polls pointing to that. Certainly if the Republicans win, it would signal the electorate kind of wants low inflation, which means tighter monetary policy and a bigger bigger impact on the dollar. Certainly then, if that happens, President Biden's ability to pass legislation will be severely reduced, which means less fiscal support through a possible incoming recession. Then kind of think that would bring forward interest rate cuts to the second half of 2023. Flip side, if there's a surprise and the Democrats win, then that would imply the electorate want low unemployment kind of idea, and that means looser fiscal policy. Covering all bases, if you like, with the election result, if we get a divided Congress, historically speaking, that tends to benefit stock markets since it limits the scope for passing anti-business legislation, such as tighter regulations or higher corporate taxes. And I think over the last 7 decades, stocks have always been higher 6 months after the midterm elections. So something to bear in mind potentially. But a split Congress would limit the government's ability to roll out new spending, which argues for slower growth and softer inflation. Okay, I just said I'd look at gold and then we'll look at oil to wrap up. So just bear with me, I'll pull up the charts. For gold, interesting, yeah, we had that big pop higher really. We were looking quite bearish, we thought actually. We tapped again, 1614, that level, that long-term fib level. But really, last time, actually, yes, we highlighted, if we just look at the monthly chart, you can see 7 straight months of declines, and that's the longest losing streak since probably the early 60s, I think Bloomberg said. And we also had then bullion-backed ETF holdings, always a driver for gold prices. They dropped to a 30-month low, and money managers holding actually a net short near the highest in 4 years. So we said last time actually that potentially had the idea of a sort of bottom actually in gold prices, or at least a snap higher. We tapped, as I say, that fib level that we can see from the 2018 lows. That's a 50% midpoint of the lows, 2018 lows, and the highs in August 2020. 50% marker at 1617. We dropped to 1614, I think, and then bounced again. So a real serious support level around that zone, 1617, 1614. And then we've popped up to another zone that we like to highlight. Actually, we have done, you can see here, support level around 1676 or so, which again, we're at now, which is the top of this bear channel, and just around the 50-day moving average at 1673. So key level, we think, for more upside. If we can break above there out of the bear channel, then we get potentially to the October highs around 1729, 1730. You've got the 100-day moving average just below their 1718 as a level for gold bugs. If we can break above here, otherwise we roll back into the bear channel, and then near term sort of support 1653 or so. That's a 21-day moving average. Okay, sorry, finally getting to oil. Interesting stuff technically. Just bear with me 1 second. Obviously, we've had the news, Chinese news potentially on the technical side, fundamental side, sorry, then giving a boost to demand potentially if there's a reopening up, obviously, and a rethinking around the zero COVID policy, then that gives a boost obviously to demand. And then we've obviously thinking about OPEC plus potentially cutting supply, but potentially that's kind of not as much as people think. So we've sort of got this underlying bid to oil prices. Let me just check. So I've drawn in, you can see actually, as luck would have it, I've drawn in some fib levels there. That's the drop from obviously the June highs down into the September lows, that low at 82.46. We had quite a sharp push higher up to the 38.2 fib level, so quite an important fib level of that downturn. That fib level at 98.06, so that capped prices. We then moved back lower before then the October sort of general sort of mid-October push up again towards that 38.2 level at 98.06. So that's initial resistance for us, we think. Held prices before and then held prices Friday and again today, actually. So potentially near term resistance at 98.06. If we do push above that, then you can see the 200-day moving average at 101.52. That's a target. Before then, the halfway point of this rally, of this downturn, and then this push higher, the halfway point being 102.88, potentially just above that 200-day moving average at 101.52. Just pulling out there to see the sort of significance of that 200-day moving average. Actually, it sort of did hold support, act as support then, but sort of been messy really around that. So maybe less significance to that, and more significance to then the near-term fib levels, 102.88, a level if we can break 98.06. If we do roll over, then we've got these support levels at the other SMAs, maybe 21-day moving average 93.25 and then 91.77, which sort of capped the upside before. That's the 50-day moving average. Okay, I hope that answered your question on oil. I think that's all we've got time for now. Hope it made some sense to you. Obviously covered a lot of things, obviously Fed being a key driver for markets, obviously near term, the China potential of the easing of the policy, zero COVID policy, and then US CPI to look forward to Thursday. I should point out actually going forward, we do have we've highlighted before actually. So last week we had a trio of central banks, but going forward, this is in mid-December, just to make you aware, mid-December we have US CPI on the Tuesday in mid-December. Then we have the Fed on the Wednesday, and then we have the ECB and the Bank of England on the 15th, I think, of December. So that is much further out, but a lot of volatility potentially mid-December. Before that, we have the US CPI data to look forward to as a mover of markets. Okay, please follow us on social media, and we hope to welcome you back to the webinar next week, same time, same place. Okay, good luck trading out there. All the best.